Welcome back. You're with us on Markets Today. Let's get through the rest of the headlines that we're tracking for you. This is the fourth one. Asian Paints fell over 2% after the company missed street estimates in the second quarter. Volume growth lower than street expectations. Margins are down close to about 340 basis points. Mangalam is here with the details on the numbers. Mangalam?
Well, it was a top-down miss that came in from Asian Paints, and it comes in directly from the top line, and it so appears that the volume growth of the company this time around has been 10 to 11%, and this is lower than street expectations of around 14 to 15 odd percent. Importantly, gross margins as well has declined quarter on quarter, even after the price hikes of almost 17% that the company has taken over the last 1 year. The improvement year on year is just about 100 basis points. So that's telling you that even realizations were under a tad bit of pressure. The overall revenue is just above 8450 crores. The street was working with a number of 8900 odd crores. The EBITDA coming in at 1219 crores. The street again was working with a number a little shy of 1600 odd crores. And that means that the margins came in at 14.4%. The company's comfortable band for margins was 18 to around 21 odd percent. So it's below that as well. And the net profit as a result of which was almost 20% below street expectations. Quarter on quarter as well, there has been a decline in both the EBITDA as well as the company's profitability. And the company said there was subdued demand conditions impacted by extended monsoon. So to that extent, it will be important to see what they do in the third quarter as well, because, large parts of the country did get a fair amount of rains even in the first few days of October. And secondly, we need to know how the festive season has performed and whether there will be some sort of margin improvement in the second half of this year as well or not. So those are a bunch of things that we'll be watching out for Asian Paints. But for now, it appears that the second quarter volumes are a miss and the overall numbers are a miss as far as expectations are concerned too.
Mangalam, don't go anywhere because Colgate too reported numbers and the stock reacted positively, ending with gains of close to about 2%. Can you take us through the numbers?
Well, for Colgate this time around, it was an uneventful quarter. We saw a revenue of almost around 1387 crores. The street was working with a number just shy of that 1400 odd crores. The EBITDA coming in at 408 crores, a little above street expectations, but that's primarily because the company went ahead and cut its ad spends. Year on year, ad spends were down by almost 15%, and that's where most of the savings came in, because as a percentage of sales, ad spends are just around 11.5% as against 13.7% same time last year. And that supported the EBITDA because gross margins year on year have declined by about 300 basis points as well. The company says that the current quarter has seen some improved momentum, but they remain cautiously optimistic going ahead. For Colgate, the bigger trend, however, will be over the next few quarters how the new MD, Prabhas Narasimhan, who was hired from HUL, performs. So that is something we'll be watching out for.
Thank you very much for Asian Paints and Colgate. Let's talk about Havells. That fell 2% after it failed to deliver in the second quarter. Varishta is here with the key highlights from the management conference call.
Well, Havells India has witnessed a soft quarter in Q2 of FY23, and the weak point has definitely been on the margin front. The margin estimates were at 10.9%, which is anyways lower than 13.8%, which was clocked in the same quarter of last year. The actual margins have come in at 7.8%, which is of course lower even than the estimates. The company says that the margins were impacted owing to full absorption of high-cost inventory, which is against falling raw material prices. But the silver lining, though, is that the margins are expected to witness an uptick Q3 of FY23 onwards. Also, the company has explicitly mentioned that the consumer demand currently is sluggish. Electrical consumer durables revenues are expected to be impacted due to short-term destocking in fans, which is led by changes in energy efficiency norms, and expect to normalize it from Q3 of FY23 onwards. Also, Lloyd's contribution has turned negative, with EBIT margins falling as low as 20% in this quarter. Some of the con call takeaways for the company were that the management has acknowledged of a high competitive intensity and them being unsuccessful in being able to pass on the full raw material price rise to the consumers, though the price hikes another round will take place in Q4 of FY23, and they are confident that these price hikes will be fully absorbed by the market. So we could expect normalized margins in Q4 of FY23. Also, the company will continue investments in advertising and building their brands, which is also for the Lloyd brand. The inventory build-up is also increasing for the ongoing festival season. This is amidst sluggish consumer demand which is ongoing. The market share in the cables and wires business is currently at 15%, while for ACs is at 12 to 13%. And in the first half of the ongoing financial year, the company had incurred approximately 165 crores of capex and expects 700 crores as the target for the full year. Now, even with a high cash balance that the company is sitting on, they are not looking at any inorganic growth, at least in the near future, but they have plans to increase their rural penetration, which at present is at approximately 5%.
Last year, we had seen unprecedented increase in the raw material prices, of which not all the entire price cost increase was passed on to the market. It was more high cost inventory at lower prices, sale prices. We knew that this will happen in the second quarter. So we do believe that this is a trough for this quarter, because most of the old high-priced inventory is now out of the system, especially for the cables and wire business, where we saw drop in margins. In all the businesses that you mentioned, all the four businesses, the major reduction has been in the cables and wires business for the reasons I mentioned. So it should be coming back to normal levels, which is in case of cables, it's usually around 9 to 10%. In the entire ECD segment, Havells has seen very good growth in the last 2 or 3 years. This destocking will continue in the third quarter a bit. So there could be some pressure on the revenue growth in ECD.
That's Havells for you. Our fifth headline for the day is on Vodafone Idea, and there could be some relief for Vodafone Idea. Reuters is reporting that SEBI has approved the government plan to convert the dues of Vodafone Idea into equity. Remember, this pertains to the conversion of about 16,000 crore on interest on the AGR dues, which the government said that instead of paying us, the interest on the AGR dues, that debt will be converted into equity. Now, the reason why the government perhaps was seeking the SEBI permission or approval, because the government planned to convert that debt into equity at a price of 11 rupees 80 paise, which is higher than where the stock is currently quoting at, which is sub 10 rupees and below face value. That's the reason why a SEBI approval was pending. Now, this comes as a relief because this conversion of this government dues into AGR dues into equity has been pending since January of 2022. That's close to about 10 months now. And only once there was clarity that, the government is going to convert its stakes, will external funding for Vodafone Idea be possible. Remember, Vodafone Idea was looking to raise about 10,000 crore of equity and plus an additional 10,000 crore of debt from banks to fund its 5G plans. But it was unable to raise that external funding because we did not have clarity on when the government will be converting its equity into, if and when the government will be converting its, that AGR dues into equity. Once it happens, so this development, the SEBI approval, paves the way for the government to go ahead and convert its interest on AGR dues, which is approximately worth 16,000 crore, into equity. Once it happens, the government will have about a 33% stake in Vodafone Idea, and the debt on Vodafone Idea's books will come down by 16,000 crore rupees. So this is a seminal step, and it paves the way forward for this long pending conversion. So that's about Vodafone Idea. Let's talk about Syngene, the research subsidiary of pharma giant Biocon. It reported a better than expected set of earnings for the second quarter. The numbers came out yesterday. The stock was higher in yesterday's trade. In terms of the numbers, the profits went up 53% year on year. We caught up with the MD and CEO, Jonathan Hunt, earlier today, who said that they expect Zoetis deal contribution to begin next year. He also added that the USD dollar strength aided the company's numbers.
So the qualification steps are really getting ready for that manufacturing, having all your plant qualified, getting the regulators both from the European Union and also from the US to come in. That should be happening in the second half of this year. The timeline is difficult to predict. It's as long as it takes the regulators to conclude their inspections and give us the feedback report. If you assume that those are successful, then we're into manufacturing as soon as the fourth quarter of this financial year, and that really then starts to ship and become a revenue driver from the very beginning of the next financial year.
That's Syngene for you. And let's talk about Max Financial. There was a conference call held today in the morning, and in that, Axis Bank is reaffirmed to being the promoter and the distribution partner for Max Life Insurance. They also said that the valuation process was completed legally as per the permitted valuation techniques. Yash is here to tell us more. Yash?
Well, to explain this, I just have to say that yesterday we did an exclusive story where we spoke about how the insurance regulator has raised red flags with respect to the transaction between Axis Bank and Max Life. A 7% acquisition is still remaining as a part of that transaction, and the regulator there wanted that 7% to be acquired at fair market value and uniform price per share, which according to the regulator wasn't done in the first part of the transaction. We asked this question to the management of Max Life Insurance, Max Financial Services in the conference call today, and what they said was that as of now they had no communication from the insurance regulator on valuation at this point of time. They personally don't believe that there was any wrongdoing with the Axis Bank Max Life transaction. The valuation for this transaction, according to them, was done as per legal valuation techniques. As far as that 7% which is in question is concerned, the management said that they'll have to see what the regulator has to say in terms of its comments when they go for an application to transfer the 7% to Axis Bank. Also, that application may be made in the current financial year itself. There was an important statement which the management gave, which is they said that they are committed to moving ahead with the Axis Bank Max Life deal with a methodology which was followed earlier. What if the earlier methodology is not accepted by the regulator? In that case, what happens to the transaction itself? That's an important question to monitor going forward.
Thank you, Yash, for explaining that story to us. With that, we're out of time on this edition of Markets Today. Thank you for watching.